Welcome to the Opening Bell Report.
Okay, so picture this. It's Friday morning, January 23rd, 2026. You've had a long week. You're just getting into it, maybe sipping that first cup of coffee. You decide to have a quick peek at your portfolio.
Which is always a dangerous habit, especially before the weekend.
It really is.
Yeah.
Because you pull up the app and there's just red. A lot of red. And if you happen to be invested in a company called Poo8 Technologies, it's not just red. It looks like a crime scene.
It was a bloodbath, yeah.
The stock is down, what is it, over 17%? It's crashed down to 6.94 cents. If you're holding those shares, I mean, your stomach just hits the floor.
Oh, absolutely.
Your first instinct is just pure panic. Sell, get me out before this thing goes to zero.
That's the lizard brain kicking in. It's that fight or flight response. And in the stock market, flight usually wins.
Exactly. It looks like an absolute disaster. But, and this is where things get really, really interesting, we have this analysis report in front of us. It's titled The Poo8 Resilience, Capitalizing on the $150 million Dip.
A very contrarian title, given the circumstances.
Right. Because the core argument here is just fascinating. It's saying that this crash, this sea of red that just ruined your morning, is not a catastrophe at all. They're calling it the ultimate buying opportunity.
Which sounds completely insane when you're looking at that chart.
It does. So today on the deep dive, that's what we're going to unpack. We're going to figure out why a stock crashes 17% and why this report thinks that's actually the best news investors could have possibly hoped for.
It's a classic setup, really. Market psychology versus the fundamental reality of the business. And to get our heads around it, we really have to set the stage.
Okay.
Usually, when you see a stock drop that hard, that fast, I mean, almost 20% in a flash, it means something is fundamentally broken.
Right. You assume the worst. A product failed, they lost a huge contract, something terrible happened.
Exactly. You think the business itself is damaged. But this time, the report argues it's completely different. The trigger for this massive drop wasn't bad news in the way we usually think of it. It wasn't a lawsuit. It wasn't a failed product. It was, believe it or not, money.
Money.
A surprise $150 million capital raise announced late on Thursday, January 22nd.
Okay, wait, let's unpack that right away. Because to the average person, to me, hearing a company just got a check for $150 million sounds like a huge win.
It should be a good thing.
Yeah. If someone handed my company $150 million, I wouldn't panic. Why did the market treat this like a funeral?
And that is the central paradox we need to get to the bottom of today. The mission here is to move past that scary red number and look at the actual mechanics underneath. Because once you understand why it dropped, you start to see why the report calls this a gift.
I do love a good puzzle. So let's get into the specifics. You said the drop was bad. How bad are we talking?
It was sharp. The report
Yeah.
details the price action. Yeah, 17.08% drop to be exact. The stock landed at $6.94. That's a serious haircut overnight.
And the cause, you said, was the $150 million. I'm still stuck on this. If a company says, hey, everyone, we just secured a massive pile of cash, shouldn't this stock go up? It means we're rich. Why did everyone sell?
It all comes down to two little words: dilution fear.
Dilution fear. Okay, break that down for us. I know the term, but let's walk through the mechanics of why that freaks people out so much.
So POE announced what's called a registered direct offering. In simple terms, they're creating and selling new shares, about 20.7 million of them.
That's a lot of new shares.
It is. And the analogy that's always helpful is to think of the company like a pizza.
Okay.
If you own a slice of that pizza, and then suddenly the company decides to cut the whole pizza into more slices to give to new people, your slice of the pie just got smaller.
I get it. So my percentage of ownership just shrank.
Yeah.
The overall company, the pie, hasn't changed, but there are more people at the table eating it.
Precisely. That's dilution in a nutshell. And when investors see new shares, their first thought, their knee-jerk reaction, is that their existing stake is now worth less than it was 5 minutes ago.
So it's an almost mathematical reaction. More shares exist, my shares are worth less, sell, sell, sell.
That's the first wave. But then you get the second factor, which is just pure market psychology. The report points out that the market absolutely hates uncertainty. And this announcement came as a surprise late on a Thursday.
And retail traders, you know, the regular folks like us, we hate surprises. It feels like we're the last ones to find out.
We are. And the report notes that retail investors just panic sold. They saw the headline, saw the word offering, and they just hit the eject button. And here is the really crucial detail.
What's that?
The offering price for all these new shares, the price the big institutions paid was roughly $7.25.
Okay, hold on. So the big, sophisticated investors agreed to pay $7.25 a share.
Correct.
But the retail panic was so bad, it drove the actual market price all the way down to $6.94.
Exactly. And that is the incredible irony the report wants us to see. Investors fled the company because it secured more money, and in their panic, they pushed the price to a discount below what the big guys had just paid.
That is just wild. It's like a store announcing they just got a huge new shipment of products, and all the customers start screaming and running out the door, leaving the stuff on the shelf for cheaper than the wholesale price.
That is a perfect way to put it. The market reacted to the mechanism, the dilution, and not the result, which is a bank account full of cash. And that's our pivot point. We've covered the panic. Now let's look at the opportunity.
Right. Because the report's big claim is that while the stock chart looks ugly, the company's fundamentals actually improved overnight. How does that work? How is a company worth more when its stock is down 17%?
Well, it starts by removing the single biggest cloud that was hanging over POIT's head. Bankruptcy risk.
Was that a real worry? I mean, they're a pretty high-tech company.
It was, according to this analysis. You have to look at where they were before Thursday. The report estimates POIT had about $37 million in cash. In the world of semiconductors and advanced photonics, that is not a big safety net.
37 million sounds like a lot to me, but I guess when you're building next-gen tech, that burns pretty fast.
It burns incredibly fast. You've got R&D, you've got these incredibly expensive fabrication runs, top-tier engineering salaries. With only $37 million, the constant fear was, are they going to run out of money?
The clock was ticking.
The clock was ticking very, very loudly. But now, look at the after picture. They have an additional $150 million in the bank.
So that's, what, 4 or 5 times what they had before?
It's a massive, game-changing injection of capital. The key takeaway here is that this creates a huge runway for them. They can now focus on commercializing their 800G and 1.6T optical engines without worrying about going back to the market, cap in hand, anytime soon.
So the existential threat is basically gone. They aren't going to starve.
The risk of insolvency has been wiped off the table, and that completely changes the investment thesis. You're no longer betting on their survival. You're betting on their execution.
That is a huge mental shift. Before, you were worried about the floor collapsing. Now you can start looking at the ceiling.
Exactly. And speaking of floors, let's circle back to that price. You mentioned the smart money, and this is the part of the report I think is most compelling for our listeners.
It really stood out to me. So who are we talking about when we say smart money?
We're talking about institutional investors, hedge funds, big capital groups, maybe some investment banks. These are people with teams of analysts who do months of deep due diligence. They don't just see a headline and click buy.
Right. So a bunch of people in expensive suits with very complex spreadsheets looked at POD and said, yes, $7.25 is a fair price. We will take $150 million worth of your company at that price.
That's it. They kicked the tires, looked under the hood, and agreed on that valuation. They wouldn't put that kind of capital to work if they thought the ship was sinking.
And yet, because of all the panic we just talked about, you, the listener, can buy the stock today at $6.94.
There's the arbitrage. The report is basically screaming that right now you can get a better price than the big institutions just finished negotiating.
That almost never happens. Usually it's the other way around. The big guys get the sweet deal and retail investors get what's left.
It's a total anomaly, and the report suggests that the $7.25 level should now act as a kind of soft floor for the stock price.
A soft floor, meaning what?
Think of it like a magnet. The price is likely to gravitate back toward that level because that's where all that serious money just came in. It validates that price point. The institutions aren't going to be happy seeing their big investment underwater for very long.
Okay, so the financial side is secure, and we have this discount compared to the pros. But I have to play devil's advocate. A stock doesn't crash this hard just because of financing, does it? I mean, maybe the tech is no good. Maybe they needed this cash because they can't actually sell anything.
That's the logical next question. Is this just a rescue mission for a failing company? And the report gives us a really clear, really timely piece of evidence that says no.
And what's that?
Literally just a few days before this crash on January 20th, 2026, POIT was at the InfoStone Awards in China.
An award show. Okay, did they just show up or did they win something?
They won big. They took home the Product Innovation Award, specifically for their 1.6T optical engines.
We keep mentioning 1.6T. For anyone listening who isn't a chip engineer, why is that number so important?
It's all about speed. 1.6 terabits per second. This is the bleeding edge of data transmission. It's the kind of speed you need to power the next generation of massive AI data centers.
So this isn't some old legacy tech. This is the future.
This is the future. And winning an award for it in China is a huge deal. That's the biggest market in the world for this kind of technology. To win an innovation award there proves your tech is real and it's world-class.
So let me get this timeline straight. On Tuesday, their tech wins a major award, proving it works and it's innovative. On Thursday, they get $150 million to go build it. And on Friday, The stock tanks 17%.
You've just perfectly described the divergence. And in the world of analysis, that kind of disconnect is often a classic buy signal. The technology is winning awards, the financing is now secure, the stock is down purely because of the mechanics of the offering, not because the business itself is broken.
It's a total disconnect between the reality of the business and the price of the stock.
And in the long run, price almost always catches up to reality.
Okay, this is making a lot more sense. But the report has this section called the voila moment. It's the deep dive insight that asks the big question, why now?
Right. This is the pivot point for the whole bullish case. Why raise $150 million right now? Why dilute your shareholders today? Why not wait for the stock to be higher?
Yeah, was it just about building up the savings account? Or is there something more strategic going on here?
The report argues very strongly that they did not raise this money just to keep the lights on. They raised it, and I'm quoting here, to go to war.
Go to war. That's an intense phrase. What does that mean in the semiconductor space?
It means getting aggressive. The report points to a note from management saying the funds are explicitly for targeted acquisitions and scaling up.
Targeted acquisitions. So they're not just paying the bills, they're going shopping for other companies.
That's the clear implication. And when you connect the dots, it all points to the AI boom.
Yeah.
We all know AI data centers are they have an insatiable hunger for bandwidth.
Right. These massive AI models need faster and faster ways to talk to each other. It's the big bottleneck.
It's the bottleneck. The GPUs are fast, but you have to connect thousands of them together, and that requires massive data pipes. And POET's optical engines, those 800G and 1.6T ones we mentioned, they are the superhighways for all that data.
So the demand is clearly there.
The demand is explosive. But here's the thing about the hardware game. You can have the best design in the world, but if you can't build 1 million units when a big cloud provider calls, you lose the deal.
Scale is everything.
Capacity is king. And before this funding, with only $37 million, Poetic couldn't really promise that kind of scale. They were fighting with one hand tied behind their back.
The scrappy underdog with great tech, but no real muscle.
Exactly. But now, by raising this cash, they're preparing to either acquire another company to get their tech or talent, or they're about to massively ramp up their own manufacturing capacity. They've reloaded.
I like that. So this dip, this scary 17% crash.
It's just a temporary event, a blip. The report argues the long-term thesis, the bet on AI hardware, is actually stronger today than it was yesterday.
Because yesterday they had a great idea, and today they had the money to actually execute it.
That's it. Cash is ammunition, and they just bought a whole lot of ammo.
So what does this all mean for the listener? If I'm looking at this situation, where does the report see the price going from here? It has some specific targets.
It does. It lays out a clear forecast.
Okay, so short term first. What are we looking at?
Short-term target is in the range of $7.25 to $7.50.
Which is, hey, that's right back to the smart money price.
Exactly. The logic is simple. The price will naturally fill that gap and return to the institutional offering price once all the retail panic washes out. Once the weak hands are gone, the price should float back up to where the serious money got in.
That makes sense. What about midterm? Once they actually start spending this war chest?
Midterm, the target is $9 plus.
$9. That's a pretty big jump from where it is now.
The thinking is that the stock will reclaim its recent highs once that cash gets put to work. Once there's an announcement about an acquisition or a factory expansion or a huge new contract that this capital enables.
So the money enables the news,
Yep.
and the news will drive the stock.
That's the thesis.
And the final verdict from the report, what's the bottom line?
They classify it as an aggressive buy.
Not just a buy, an aggressive buy.
No, they are not mincing words. They see a clear dislocation between the fundamental value of the company and its current stock price. They believe the panic selling created an artificial window of opportunity.
It's a sale.
It's a sale, and it was caused by a misunderstanding of what this financing really means.
It's incredible, really. We started this whole deep dive looking at a chart that just spelled disaster. But when you peel back the layers,
It's a completely different story.
yeah, it looks like a company that just finished fueling up the rocket ship. But a bunch of the passengers got scared by the noise the engine was making.
That's a fantastic analogy. The engine roar, the noise, that was the dilution. It scared people. But that's the sound a full fuel tank makes.
And a full fuel tank means you can actually go somewhere.
Precisely.
So just to recap for everyone listening, Kuwait Technology stock dropped a scary 17% because they raised $150 million by issuing new shares, and the market panicked about dilution.
But underneath that surface-level panic, you have a company that just eliminated its biggest financial risk. Their core technology was just validated with a major award, and they got a huge vote of confidence from smart money at a price that's higher than where the stock is today.
And most importantly, they are now armed with the cash they need to go out and capture a huge piece of the AI market.
That is the story the report is telling. It's not a story of failure. It's a story of preparation.
Before we go, I just want to leave our listeners with one final thought. We talked about this $150 million war chest.
Right. It's not pocket change.
No. And if they're raising that kind of money, specifically for targeted acquisitions in the AI space, it raises a really interesting question. Who exactly might they be looking to buy?
Oh, that is a good question.
And maybe more importantly, what does the fact that they're preparing for this tell us about the sheer scale of the demand they see coming? You don't buy a new factory or a competitor unless you're pretty sure you have the orders to justify it.
It strongly suggests they might have visibility into a demand pipeline that the rest of the market hasn't priced in yet.
They might be seeing the tidal wave forming just over the horizon.
The cash raise is the signal. Now we watch what they do with it.
Watch what they do with it. I love that. Well, that's all the time we have for this deep dive. Thanks for listening, and remember, sometimes when the market is screaming panic, the data is just whispering opportunity. Keep looking for the signal in the noise.
See you next time.
Don't forget to like, share, and subscribe for more.